Hello, everyone, and welcome to today's webinar, Part 1, Top-Down Budgeting Made Easy. My name is Olivia Roma, and I'm the meetings manager here at PSMJ Resources, Inc. Today's speaker will be Kate Allen, who's the director of AEC Surveys. So before I turn this over to Kate, I would like to provide you with some helpful information. On the next slide, you'll see information about the technology that you'll need for today's webinar. To hide the control panel, click on the arrow pointing to the right. To adjust your screen size, click on the screen button located at the lower right corner and select full screen. On the control panel, you will see a tab called Handouts, and below that you will see a link. Click the link to access a PDF copy of the slides for you to use during today's webinar. On the control panel, you'll also see a tab with a chat with a plus sign. At the end of the webinar, we'll be doing open Q&A with the speaker. To submit general questions or questions about the content, certificates, anything like that, click that plus sign, type in your question, and click Enter to submit. If I do not address your questions by the end of the webinar, I'll be providing you with Kate's information. You can follow up with her directly. I'll also be sending all these questions to Kate so she can follow up with you as well. On the next slide, you'll see information about the credits. PSMJ is an AIA CES provider. This webinar has been approved by AIA CES to provide this content to both AIA and non-AIA members. So by attending today's live webinar, you can earn 1 LU hour, PDH, or CEU. To receive your 1 LU hour, please email your AIA number to education@psmj.com so we can submit the credit for you. To receive PDH, CEU, or any other type of credit, we'll be sending you a certificate after the webinar which you can use to submit yourself to the appropriate board. Please note that not all state and licensed boards accept these type of credits. For more information, please contact us directly by emailing education@psmj.com or call 617-965-0055 extension 140. On the next slide, you'll see information about what will happen after today's webinar. We will be sending an email to you with all the important information, including your certificate, how to receive credits, the webinar recording, and more. If you're watching the webinar with a group of people that need a certificate, I'll also be including a form in this email for you to complete and return to me so we can create a custom certificate for those attendees. So now that I've provided you with all this helpful information, I'm pleased to turn this over to Kate.
Thanks, Olivia. And thanks everyone for joining me today. I developed this two-part webinar series because I really want to teach a method of top-down budgeting, and I've tried to break it down into 6 simple steps. So we're going to start with revenue forecasting, then we'll estimate our expenses, and then we'll wrap up with about year-end allocation of profit over the 2 webinars. Throughout the course, I'm going to use data from PSMJ's financial performance and management compensation benchmark survey reports, just kind of to check our assumptions and results and to make sure that they're reasonable assumptions. So just a reminder, I can take questions at the end and you'll submit them in your toolbar to your right. If you have any trouble hearing me or seeing the slides, please don't hesitate to let me know as well. As Olivia mentioned, we'll send a copy of the slides and the recording after today's presentation. So first of all, let's start with just a brief review of our agenda for today. The entire 2-part webinar series will cover 6 simple steps for top-down budgeting, but today we're just going to focus on 3 of those: estimating net revenue capacity, allocating raw labor costs, which allows you to calculate chargeability, and finally we'll calculate our target direct labor multiplier for our little sample firm here. So just a little bit about myself. I'm a mechanical engineer, and I worked as an engineer for about 15 years prior to coming to PSMJ. I started my career with a firm of about 60 people that grew to about 200 over an 8-year period, and as an associate owner of that firm, I managed a business unit of 30 mechanical electricals that worked exclusively in the healthcare market. I left that firm, co-founded Cavio Consulting Engineers, also an MEP firm that serves the healthcare market. And I sold my interest in the firm and was recruited by PSMJ to facilitate financial management seminars in about 2005. And since that time, I worked with firms on strategic planning, ownership transition, valuations, merger and acquisition, and really overall operational and financial assessments. If you're not familiar with PSMJ, I just want to share with you a little about us as well. This table shows you the basic services that we provide in our areas of expertise: strategic planning, marketing, project delivery, finance, etc. and then the different ways that we deliver our content. So through newsletters, surveys, and books, which you're going to get a view of some of the survey data today, seminars and conferences, and then we also do one-on-one consulting. Something that's a little bit different about PSMJ, if you haven't been to one of our webinars before, is that we're dedicated to serving the AEC market. We've been doing this for more than 35 years, and all of our consultants and instructors are former architects or engineers or finance people that have worked in all sizes and types of AE firms. So we're very familiar with the industry. I started to offer this webinar series about 3 years ago because I think there are a lot of us that started out as engineers and architects that really don't have a solid understanding of how the financials can help us not only keep track of our business performance, but they can also help us analyze and develop strategy to drive our firm's performance, which in my mind really starts with budgeting. So we have a lot to cover today, so let's jump right in. We'll start with estimating net revenue capacity, which answers the question, how much revenue can my firm, my team, my branch, or my group reasonably generate? Once I know my net revenue capacity, then I can allocate my wages, which are also called raw labor costs, into direct and indirect labor expenses, which then allows us to calculate chargeability. So once we have our net revenue capacity and our direct labor costs, we can then calculate our target direct labor multiplier. It's important to keep in mind that a budget is simply a model. It's a place to test what ifs, and the quality and accuracy of the input will impact the results. So as with any model, garbage in gives you garbage out, but I believe this model is pretty straightforward, and I've gotten good feedback that most people seem to enjoy using it. And it's simple enough, and when you check it for reasonableness against industry benchmarking data, you can develop a pretty solid, reliable budget for the year ahead. So why do we have an income statement up here? And the reason is because budgeting is usually recorded and reported using an income statement format. And we're actually going to work in our budgeting process from the top of the income statement to the bottom of the income statement. So the top-down budgeting is what this is called. The general layout of any income statement is to start with income or revenue, which is generated through invoices. And just to be clear, gross revenue includes any subs and reimbursable expenses. Net revenue does not. Net revenue is really the revenue that your in-house staff will be directly involved in generating, and those are the same funds that then you can use to pay rent, insurance, wages, etc., all the costs associated with running a firm. We will only be talking about net revenue today. Next is really the cost of goods sold, or how much did you spend to deliver your services in both labor and non-labor direct project costs. Next is expenses. These are the costs incurred in running your firm, such as rent, administrative or overhead salaries, non-project related salaries of also technical staff, and things like your insurance. At the 60,000 foot level, we have income here, minus cost of goods sold, will give you your gross margin, and your gross margin minus your expenses will tell you what your remaining profit is, which is also called earnings. So key to understanding finance is to really understand what key terms mean. And many of you may have heard this story if you've joined me before, but when I was in MBA school, I was about 4 chapters into my finance class before I realized that I didn't understand the difference between revenue, income, and earnings. As an engineer, I was completely comfortable solving the math, but I couldn't interpret the results. So I had to back up and start over chapter 1 and learn the vocabulary associated with finance so that I could make the numbers and the results meaningful. So we're going to start with a few key terms for today. One of those is net revenue, and again, this is the revenue that's generated by your in-house labor. Direct labor is the project labor, which is priced at raw salary cost. It's without burden. Indirect labor is all labor not charged to projects, again, priced at raw salary cost. We don't want to include burden. Raw salary cost is the base salary that you pay someone, again, but it does not include fringe benefits or burden. And we'll talk more about that. And a few more terms, chargeability. So what percentage of your raw labor costs are allocated to project-related work or time, which we also call billable time or utilization. And then target direct labor multiplier. And based on your model, this is the target markup anticipated on your direct labor costs. And again, we'll go into more detail. I just want to make sure we get the definitions out there. So let's start with estimating net revenue capacity. As I previously mentioned, if I didn't mention it, I will mention it now, that I developed an Excel-based worksheet that will be referenced in the materials from this point forward. And actually, at the end of the second webinar, a complimentary copy will be sent to you. I've labeled the columns alphabetically, A, B, and C, etc. And I've indicated whether the data or if it's a calculation that relies on output in red here. The example that I will use throughout the webinar series, and I'm just trying to keep things simple, is a 7-person firm that practices in engineering as a subconsultant, such as an MEP firm. These 7 people could just as easily be a team. They could be a branch office, a department, a studio, etc. But for this purposes, this is the entire firm. Once you've listed all of your employees, here, principals, technical and non-technical staff, full and part-time, you'll start with column A, where you'll input the number of annual hours for each person. Many of our staff are on salary, and a full-time work year is 2,080 hours in the U.S., 1,950, I believe, in Canada. I may have that a little bit high. So that's what we'll be working with. I've included a couple of hourly staff as well, one that works part-time, which is Julie here, and one that works about 10% overtime but is still paid hourly, which is Sue. Here we can see that my firm of 7 should be working about 14,000 hours in the year ahead. In column B, I estimate the percent of each person's work time that will be spent on project work. So for example, John is expected to be 55% chargeable or billable. In column C, I input their average hourly billing rate. Many firms have rate tables that change by client or project, so it's best probably to use an average hourly billing rate for each person. And we can see here that my firm's total average hourly billing rate is $106 per hour. Many firms might use this number to do a rule of thumb check when they set project fees. If you're starting to ask your team leaders or group leaders to develop business plans for their team's year ahead, this portion of the tool, items A through C, can be used to help them better understand how much net revenue their group can do in a year, which can then be broken down by week, month, whatever you like. And it may help to better understand and support their sales efforts to achieve this amount of net revenue. So generally, billing rates are published firm-wide, and using this method, salaries for each person really have not been revealed. Once we get past calculating net revenue capacity, you'll only want to use the full tool with staff that have access to salary data. It's really been quite enlightening when I've done this exercise with kind of the next generation leaders in a firm. Many times it's been their first experience in working with financial data at this level, and they now realize why they have to meet their chargeability goals and why they need to develop some level of sales skills, even if it's just bringing in repeat work to help meet the goal for net revenue. You know, we're in the business of doing projects, and projects generate net revenue. So it all starts with understanding net revenue capacity for a firm, a team, an office, really any group. So let's move on here. Once we've input columns A, B, and C, then we multiply each of those together to estimate the net revenue capacity each person can generate based on our assumptions, our modeling of how much of their work time is spent on project work. So say for John, he's a full-time salary position at 2,080 hours. He's expected to be 55% billable at an hourly rate of $175, which means he can generate about a little over $200,000 worth of net revenue for the year. For Julie, who works part-time at 1,560 hours a year, she's expected to be, during that time, 25% billable at an hourly rate of $60, which means she can generate a little bit over $23,000 of net revenue for the year. You just continue on and calculate this for each person in the group. Once we've done this for each person, in column D here, which is A times B times C again, we can see that our firm has the capacity to generate a little bit over $1 million in net revenue. Again, I have found this exercise alone to be especially helpful when I have a team leader that has been asked to estimate how much net revenue their team plans to contribute to the firm's overall revenue goals in the year ahead. So don't hesitate to share this portion of the tool with them. Many times they have no idea where to start. So this gives them a model that they can work through to figure that out. So now let's take a little step back and look at how reasonable our assumptions are. The first thing we do is validate our hourly rates. Are we charging enough for our services? If our hourly rates are too low, then we may be underestimating our net revenue capacity. So let's look at John and say he's a principal. We have him as other principal in our management compensation data, and compare his hourly rate to benchmarking data. All of PSMJ's benchmarking data is broken into peer groups so that you can compare your firm to other firms that are most similar to yours. If you're staff size 1 to 20, you probably don't want to compare yourself to a firm that has 250 to 500 people. So you can see here that if we build John out at $175 per hour for principal and firms that practice engineering sub, 175 is just below the median. And if we look at, if we look at engineering sub, it's pretty much right on. So I can be pretty comfortable that this billing rate of $175 per hour is reasonable. And we can do this for each of the positions. Once I've done that, I can make any adjustments needed, and now I'm pretty comfortable that a key input to my net revenue calculation looks pretty good because I've compared it to industry data for firms that are most similar to mine. We can also check our overall net revenue capacity number by looking at it based on our total number of staff. Again, our estimated net revenue capacity is just a little over $1 million. We have 7 staff, so our net revenue per staff member is about $145,000. This doesn't mean that each person is responsible for generating $145,000 of net revenue, but really it's another data point that we can benchmark and check for reasonableness to validate our assumptions so far. So this data is from PSMJ's 2016 Financial Performance Benchmark Survey Report, and you can see that when we look at our peer groups, again, firm size 1 to 20 and engineering subconsultants, the $145,000 is just below the 75th percentile for firms of our size and just above the median for engineering sub firms. PSMJ presents data based on percentiles. So if you're familiar with the normal curve, the median means that of all the firms that provided data, 50% fell to the left and 50% fell to the right. So it's not a mathematical average or a mean, it's a true median, which is also called the 50th percentile. And what we see here, it looks like our net revenue capacity seems to be pretty reasonable. So let's go into estimating and allocating raw labor costs next. Using the data that we've already input into columns A and B, we can calculate the number of billable and non-billable hours. So let's just take a look at John again. His number of annual work hours as a full-time employee is estimated to be 2,080 hours for this example, and he's expected to be 55% chargeable, which means that of that 2,080 hours, 1,144 will be spent on project work. The remaining 936 hours is not allocated to project work, but may be used for marketing, handling HR issues, or general administrative duties. Could be vacation, holiday, sick time, etc. I know that John as a principal will probably work more than 2,080 hours, and you're welcome to adjust any of these inputs to more closely match your specific situation, but I really want to keep it simple and straightforward for this example. Also, if you do model more than a full work year, make sure that the model isn't adjusting their annual salary, we'll see that later, to match their increase in hours if they are salaried staff. You'll need to know a little bit of Excel to make those adjustments, but if you run into any problems, don't hesitate to let me know and I'll help you through it. So again, we do this for each person, and you can see that we are anticipating about 8,600 total billable hours here, and about 5,500 non-billable hours for our firm. Some of you might be tempted to use this information to calculate chargeability for the firm, but hold off for just a minute and let's translate these hours to raw salary expenses first. Let's continue on, and we'll allocate our raw salary costs or wages to direct and indirect labor. And just a reminder, raw salary is the base salary and does not include fringe benefits, which are also called burden. If I pay someone $60,000 a year and they work full-time, then their hourly rate is calculated by dividing that $60,000 by 2,080 hours, which is about $29 an hour. So let's use John again as an example. His annual salary is $104,000, which is about $50 an hour. Now we can use this hourly pay rate to allocate his raw salary expense to either direct labor costs or indirect labor costs based on the number of hours he plans to spend on billable and non-billable work. The portion that will go to direct labor based on this model is just over $57,000, and nearly $47,000 will go to indirect labor, or overhead as it's called. We could have skipped calculating the breakout of hours and simply used their estimated percent billable, but if you plan to do much benchmarking, you'll find that the benchmarking data is reported generally in terms of percent of direct labor, or per hour of direct labor, or per total hour. So having it already documented this way can save you a lot of time. I also find that many times my PMs or technical staff prefer to work toward a target of total billable hours versus a percentage of billable. So again, that data is here at your fingertips if you choose to use it as well. Many firms that I work with have an account in their income statement where they track wages as a single entry under expenses. And I strongly encourage you not to continue this practice. Instead, we'd like to see wages broken out or allocated into wages that were paid for work on projects, which is also called direct labor, and wages paid for overhead type activities or non-project work, which is also called indirect labor. Once you do this, you can easily see where your wages are going, and you can do all kinds of analysis of your income statement and know exactly where your firm stands at any time. Again, we do the same thing for each person, and from that we can estimate what our total direct labor expense, total indirect labor, so here's our total direct labor expense, here's our total indirect, and what our total raw wages are going to be for the firm. So for our firm, we anticipate a little bit over $300,000 in direct, about $176,000 in indirect, and our total labor cost will be about $483,000. So now that we have our labor or wage expense allocated to direct and indirect, we can calculate the chargeability or utilization for our firm. And we prefer to calculate chargeability based on labor dollars instead of hours because it takes into account the different salaries for all staff in your firm. If we calculate chargeability based on hours, we aren't accounting for the different salaries in our firm. We're only looking at the allocation of hours, when really the allocation of labor costs is much more informative. So if you are only considering chargeability for one person, you can use hours or labor dollars. If you're calculating chargeability for more than one person, say a team or a firm, that do not use labor hours, use labor dollars. 1 hour of a principal's time does not cost the same as 1 hour of a junior project manager's time. So using labor dollars or comparing direct labor costs to total raw salary costs accounts for this difference, and we're more concerned with how our labor dollars are being spent, whether it's being spent on project or non-project work, than we really are on where people's hours are being spent. So to determine how chargeable your firm is expecting to be, you divide the total direct labor expense by the total salary expense. In our case, our total direct labor expense was just a little over $300,000, and our total salary expense was $483,000, which tells us our chargeability based on our modeling. Again, we can go back and change factors in our model, should be about 64%. Again, we can check this for reasonableness using benchmarking data from PSMJ's 2016 Financial Performance Benchmark Survey Report. And here we see that for firms of similar size, 64%, my little red dot fell off, but it should be right here, falls just below the 75th percentile. And for firms that practice as engineering subs, our 64% falls just above the median. Again, seems very reasonable. Reasonableness checks on key inputs and outputs using benchmarking data can help you validate your budget entries and assumptions, and it can also help you make a case for change if that's what you're looking for, because now you have the data to back it up. So one last step for today, using the data we've already created and calculated. Let's look at our direct labor multiplier. So the basic calculation for target direct labor multiplier, and again, why do I say target? Because we have estimated our net revenue capacity. It's a target, monthly, quarterly, or annually. we can look at our year-to-date income statement and use that to calculate your achieved direct labor multiplier. So for now, by dividing our total net revenue capacity by our estimated direct labor costs, we can see that our target direct labor multiplier is 3.31. For decades, the multiplier was a 3.0, and it started to improve just before the last recession, fell off again, and has recovered and has made it's been actually holding steady for about the last 3 years. So the next question we have to ask is this enough to cover our overhead costs and provide for a reasonable profit? And we'll take a much deeper look into that and during our next session on September 27th. So before we wrap up and move on to questions today, let's see how reasonable our target is. What are firms that are similar to us achieving in terms of their direct labor multiplier? So this is what they're actually achieving. So is your target somewhere near what you're achieving? And here we can see that our goal of 3.31 is just above the median for firms of similar size and just below the 75th percentile for other firms engaging in engineering subconsulting. So again, the goal looks reasonable. We're going to stop there today. I know next time we have a lot more to cover, but I wanted to try to break it into kind of 2 equal parts here and leave plenty of time for questions and answers. And I'll open it up for questions. While you're typing in your questions, I just want to let you know that as part of your participation in today's webinar, we wanted to give you a special offer. And again, if you're not familiar with benchmarking data, this is a good opportunity to learn a little bit more about it. So 2 things that I would like to encourage you. Number 1 thing I want to do is help you with your budgeting. Number 2 is I want to encourage you to participate in all of our surveys. Without participants, I can't bring this data to you that allows you to know where you stand in your performance as a firm. So for today, we're going to offer, the deadline is October 28th, 20% off our financial performance benchmark report or 20% off the full set. And our full set right now consists of our management compensation, which we used, we didn't use that data today, but we did for billing rates, staff compensation, financial performance, and then bonus and benefits. It's only published every other year, so currently we're working with 2015. And if you use the coupon code budget when you order, then make sure that you get that discount. So at this point, I'll pass it back to Olivia, and she'll kind of go over the post-webinar reminders here.
Great, thank you, Kate. And just a friendly reminder to everybody, to enter your questions for today's Q&A session, you want to go to your meeting panel. You'll see the chat with the plus sign. You want to click that plus sign, type your question, and click enter. We have plenty of time for Q&A as we have about half hour, and Kate's ready to answer them. So take advantage of this time while you have her here and get some free consulting out of it here. So what we're going to do is, first is a friendly reminder, after today's webinar, we'll be sending an email that will include your certificate. And if you require multiple certificates, if you're watching in a conference room with people, I'll be sending a form that you complete and send to me so we can create custom certificates for those people. Credits, again, if you need your LU hours, please email your AIA number to education@psmj.com and we'll submit the credit for you. For everybody else, you'll take your certificate and report yourself to the appropriate board. You'll also receive the webinar recording from today's webinar that will also be posted on our PSMJ website. You'll receive information about the special offer for you to take advantage of and information about the webinar next week, making sure that you don't forget about it. You don't have to re-register. Once you register for the webinar, you're automatically registered for part 1 and part 2. So if you go to the next slide, you'll see our Q&A session is about to begin. And what we're going to do is, for those who do have to run early, we'll keep both Kate's information in mind. So if you have any questions about the content, or if we don't address your question by today's webinar, you can follow up with her directly. And if you have any questions about credits, certificates, future webinars, etc., feel free to follow up with me directly. And we'll also include this information in the follow-up emails just in case you don't have time to write it down. All right, Kate, so it looks like a lot of questions are coming in right now, so we're going to go ahead and get started.
Great.
So the first question I have is from Maxine. And Maxine would like to know, why do you include overhead people when calculating net revenue capacity, like Peggy?
It's not necessarily that they're going to generate revenue. It's more important that they're included in my overall cost because we're doing top-down budgeting. So that's the first step is to figure out where their labor goes. It'll show up in indirect, and then we're going to look at overhead rates and overhead costs next and during the next session. So it's important to have everyone represented when you do that revenue forecasting, whether they generate revenue or not, because it's part of a bigger workbook.
Great, and the next question I have is from Catherine, and Catherine would like to know, for salaried employees, do you not account for time over 40 hours? This is actually what's required to get the job done. How is this accounted for?
You can account for it, and I believe in a previous slide I indicated what will happen in the model is if you, for example, let's say that you have a salaried person at 2,080 hours and they're going to work 10% overtime. You might bump their hours up, but in the math in the model you need to make sure it isn't pushing their salary up accordingly because we're looking at everything on an hourly rate. So we would have to make some modifications so that it holds their salary constant, and then you can still use the revenue because the revenue is being generated based on where are they spending their time, and then we're looking at how do we allocate their labor dollars. So because you pay a salaried person 10%, because you don't pay them overtime, we want to make sure that their total salary number does not bump up. So you'd have to fix that number on the model so that it doesn't change with the number of hours, but it will change your revenue numbers because we're looking at that based on hours. And hopefully that makes sense. If it doesn't, please, type another note and or contact me directly and I'll try to answer that again. Hopefully that takes care of it. Okay. Answers your question. Sorry about that.
Okay, and again, Catherine, like she said, Kate's information's here. You could go ahead and re-enter your question in the chat box if you have anything to elaborate on. The next question we have is from Diana, and Diana would like to know, where would you put direct labor that you know will not be billable? Still under direct or indirect instead?
It still goes into your direct because your intent is that, again, the direct labor, I'm going to go up to the model up here. Let's try to use that a little bit. So what you're talking about is when you have direct labor that's been charged, but it can't be invoiced. So really what it is it's a WIP write-off or a work in process write-off. And I would keep track of that for my project managers so that we make sure that we are recovering all of our project costs. A lot of times project managers might be hesitant to go back out after change orders or additional fee that's owed to the firm if the scope changes, for the project. So direct salary here, we're modeling saying we're assuming that all of John's direct salary, $57,200, is billable. If we find out that a lot of it isn't, then we have a different problem. We have a project management or an efficiency problem. So this is, again, just modeling what we can do for the year ahead, but you have to manage it and you have to make sure you stay on top of it. If you find out John is not able to bill a lot of his work, then he really isn't contributing to net revenue, but he's putting his salaries being allocated to direct labor. And that'll show up at the end of the year in your income statement because all of that labor that you thought was going to generate income, if it doesn't generate income, it'll show up in your achieved direct labor multiplier. And that's pulled off your income statement. This is modeling what we'd like our target direct labor multiplier to be. Your income statement, which is really a scorecard of all the operational decisions that you've made, is where you will find out if you achieved that or exceeded that or you didn't hit it at all, which happened for many, many years in this industry. We would set a mark of 3.0 and we'd maybe hit 2.7, which is a substantial amount of money that's been left on the table. But we've improved so well in our project management and our process and our efficiency that's no longer the case. We're actually finding target and achieved direct labor multiplier are lining up really well. So hopefully that answers that question.
Great. And next question that we have here is from Dax, and Dax would like to know, is revenue factor or direct labor multiplier a better benchmark?
Actually, revenue factor is, and we're not going to talk about that much during this, but revenue factor for everyone, just so that we're all on the same page here, means that we're looking at chargeability and we're looking at the achieved direct labor multiplier. When you multiply those two things together, you get revenue factor. So I don't have a simple example in my head, but if your chargeability is 50%, to be 0.5, and then you would multiply that towards your achieved direct labor multiplier. Let's say it's a 3.0. And I apologize, but I don't do math in my head at this point. But revenue factor, just so you know, because it has those two components to it, I consider chargeability to be the quantifier, where was the time spent, and then I consider direct labor multiplier to be the qualifier. Okay, so I spent all this time on chargeability, but if it didn't move over to net revenue, you know, similar to the question that was previously asked about having to write things off in WIP, if it doesn't move over to net revenue, then I'm going to have a lower achieved direct labor multiplier than I would if all of that had converted into net revenue. So revenue factor allows you to look at both of those at the same time. But if you have a problem and your revenue factor is low, you need to break it into those two parts and see which one is contributing to it. Is it the chargeability function, or is it the achieved direct labor multiplier? And just as a rule of thumb, if you have a revenue factor of about a 2.0, I guess my other one was a 1.5, but if you have a revenue factor of 2.0, generally you're probably hitting about 20% profit. That's held pretty true, and it's tracked very well over many years of collecting financial data. Hopefully that answers that question.
Okay. While you're on slide 25, Kate, we have a question about slide 26, which is, can you please review the labor dollars definition?
Yes, so direct labor expense. Okay, so if I'm paying a total raw salary of $483,440, again, this is without fringe or without benefits because I'm going to push all that into overhead. I'm not concerned with that in this modeling step. If I have $483,440 in total raw salary, I need to know, based on my model and how chargeable I've asked everyone to be, et cetera, how much should I expect to see in direct labor, which means that a little over $300,000 of our labor expense was spent on project work, which is really our widget. It's what we create in order to create revenue. So direct labor is a very important factor, and breaking it out from total salary is very important. And then the rest of it is indirect labor or overhead. And that indirect labor expense is going to be made up of not only your administrative staff, HR, marketing, etc. It's also going to be technical people that are not spending their time on billable work. And just to be clear, everyone will have some indirect labor unless they're contract help, because they will have holiday, vacation, sick time, etc. So everyone will have some of their labor pushed over here, some of their labor costs pushed over here. But you really want to balance this out and make sure that you have a good, strong chargeability of probably somewhere between 60 to 70% for your firm. It's probably a good rule of thumb, rough range. So we would take our direct labor divided by our total salaries, and that would give us our chargeability ratio. If this was much lower, then our chargeability would be much lower, and I would have to go back and look at all the individuals in the model and say, you know, goodness, what do I need to do to try to make this a little bit different? Let's push up to here. So what do I need to do here? Do I need to add staff? Do I need to push, does John need to be more chargeable? What needs to happen in order to make sure that we reach a reasonable chargeability goal? And these are great questions, so thank you very much, everyone.
Definitely. We have a lot of questions and still some time here, about 20 minutes left. And while you're talking about direct labor, Kate, can you just elaborate a little bit more on direct labor multiplier, the importance of it, and how firms use it?
Sure. So direct labor multiplier, and let me just see if we have a good slide here that would, which we do, because we did it at the very end. So direct labor multiplier is saying how much labor did I have to expend in order to create the revenue that my firm generates. We're modeling what we want to have happen here. When you get to your income statement, you're going to know what happened, because again, that your income statement, different than your balance sheet, but your income statement is your it's your scorecard of all the operational decisions that you make throughout the month, throughout the quarter, throughout the year. Your balance sheet is just a moment in time. It's like opening your checkbook and looking at it at 2 o'clock today. It might look different at 4 o'clock today. I mean, it still has a lot of good features and functionality. I don't want to diminish it, but the income statement is where you're going to keep track of this. So what this means in our industry means that this is how much I had to pay in labor in order to generate this much net revenue. The industry, again, set at a 3.0 for many, many years as a target. And achieved much less than a 3.0 for many, many years, for about 20 years. And finally, the two have caught up to each other so that the target and the achieved, the target as modeled and the achieved as we find on our income statement, have actually converged. So we're doing a really good job with projects. And to give you kind of an equivalent, something to consider, if I was in manufacturing, my direct labor expense would be how much does it cost me in parts and labor to create my widget in order to drive income for my company. Instead, what we do is we sell labor. We do projects, so we're a labor-based business. So how much labor did it cost me to generate my income or my net revenue? So direct labor is very important. If you're lumping it all together in a thing called wages or salaries or whatever, and you're holding it in your expense section, I strongly, again, encourage you to break the two out, because direct labor really becomes part of cost of goods sold, because that's what it costs us to generate that revenue or to create that widget. And we're going to go back up to the income statement real quick. So gross or direct labor is really cost of goods sold, and any of your indirect labor is going to be part of your general overhead. So make sure that you get those two things broken out. And that's probably the number one thing that I find on income statements when I do consulting with firms, is that wages show up as a one lump item, one lump sum item. And unfortunately, I have to push them to go back to their timesheets to find out how we should allocate these funds between direct and indirect, so that I can do any type of analysis on their firm's performance. So it's a critical number. Not enough firms do it. And if you leave today with nothing else, please make sure that you get that separated on your income statement.
And when they're working on that income statement, I have another question from an attendee wondering if direct labor includes payroll taxes like Social Security, Medicare, that they have to match.
No, that's all actually part of your burden for your labor. We're going to talk about that next time, and that's actually an expense. So all of that will show up down here in the expense portion of your income statement. It doesn't mean it's not a variable cost and that it doesn't change with labor costs, right, with how many people I have in my company, et cetera. But it's an overhead cost, so we want to keep it down in expenses. And again, remember, this is raw labor up here. This is without burden. The burden is all carried down here actually in labor overhead, and we're going to talk more about that next week.
Okay, and the next question I have is from Dominic, and Dominic would like to know, does the 2016 survey note/measure employees' burden across firm size or firm type?
Both. We give you those numbers in both, and I'll show you some of that data next week. We always, in our data, whenever we present our benchmarking data, we always give it by firm size, and you saw the breakout 1 through 20. Let's just go to sheet here real quick. You can see we break it out by firm size. We also break it out by practice area. We also break it out, and I didn't include that here just to keep the slide a little from being overburdened. We also break it out by private, public, or mixed clients. And then if we have enough data, we actually do it by market segment as well. So for example, if you practice in transportation and the bulk of your revenue comes from transportation, you can see that number down there, or healthcare, or water, wastewater management, things like that. So we try to give the data broken out in as many different peer groups as what we call them. So size, practice area, client type, or market sector. We try to give you the data in as many different peer groups as we can so that you can do your best to compare yourself to firms that are most like yours.
Okay, we have about 15 more minutes and still taking questions. And the next question is from David from a firm in Canada, and he would like to know, or is saying that in Canada, employers remit amounts to the government for employment insurance and the Canadian pension plan. Should these be included in the direct labor expense amount or excluded like benefits/burden?
I would include it in benefits/burden so that I could keep track of it separately, because I know it's different in Canada, and I know that these costs are associated with the labor hours or the labor pay is similar to here in the States, but I would keep it separate. The way some architects, not very many engineers, but some architects do it is they actually calculate, instead of a direct labor multiplier, they calculate DPE, or I think it's called direct personal expense, and that is labor with all the burden included. So you can look at it both ways. We present the data both ways in the financial benchmarking survey. But really the market really has primarily moved to direct labor multiplier, which means we want to just keep our direct labor clean and separated from our overhead benefits and burden.
All right, next question is from Dustin, and Dustin would like to know, what if you have a salaried person who puts in greater than 2,080 hours? Do you use 2,080, or what do you think they will actually put in for hours?
To be conservative, I would model them at 2,080 hours, so that I know that as baseline, this is what my firm can generate, right? And we're going to talk about how that looks as profit and overhead expenses, etc. Because a lot of times when people work those overtime hours, it does not necessarily increase your expenses unless they're an hourly person. So again, if you do want to model that, you need to do a little bit of changing in the math and the model that you'll get next week. And if you run into any problems with that, let me know and I'll be happy to help you with it. But yes, you can absolutely model it. In fact, you know, when you set up a model for the year, you might want to set up one that's very conservative. You might want to set up one that's somewhat aggressive, and maybe another one that is very aggressive. And maybe you'll reach somewhere in between. But at least you'll know what your baseline is if you model conservatively first, which would be at the 2,080 hours. But I can tell you that when I do the modeling myself, I'll do it several different ways. I'll also use the model to figure out billing, you know, how much, if I was going to do a compensation study, let's say, and I wanted to increase people's salaries, you can also use this tool to see, well, what happens if we do that, right? What happens to our costs? What happens to the revenue that they need to generate in order to cover that cost? So this is a really good fundamental tool that can be very helpful in better understanding your business, communicating with other people about, you know, what we can and cannot do, and what the impact is to some of the decisions that other people might want to make. So this is only the beginning of it. There's another section to it, and we'll get to that next week. But thanks.
Great, thanks, Kate. And the next question we have is from Elizabeth, and Elizabeth would like to know, is labor overhead the same as indirect labor?
No, it's not, and I'll give you that definition next week, but labor overhead is the fringe or the burden. Indirect is actually included in general overhead. So if we look at this, you know, my little pseudo income statement here, and just try to keep it simple, labor overhead is the burden, and general overhead will include indirect labor, rent, insurance, etc. So I'll show you how to estimate that next time, and also how to benchmark it.
Okay, next question I have is, what do you do with bonuses for employees? Do they get allocated between direct and indirect?
Actually, bonuses, ideally, if they're truly discretionary, should be below the line. So sometimes you'll see another section down here called other expenses or income. I would push it into that section. If they're not discretionary, then they should be part of your indirect labor. If they're discretionary, keep them below the line, because in all of our benchmarking, we want to know what our earnings look like before bonus and taxes. You may know of a phrase called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. We don't really have much EBITDA in this industry because we don't tend to carry taxes, depreciation, amortization, etc. So we actually call it EBBT, or earnings before bonus and taxes. And every firm has a different bonus strategy, and every firm has a different tax strategy. So when it comes down to, for example, we look at this profitability, we would want to know that before bonus and taxes. So if you're doing bonuses, they're truly discretionary. There's another section on the income statement down here called other expenses and income. Keep it there. if it's not discretionary and you pay it out and it's really a part of compensation, then it would go into general overhead or indirect labor, which is a portion of general overhead.
Great, thank you, Kate. The next question I have is from John, and John would like to know, are there firms that track labor on lump sum projects which are over budget as indirect labor?
Say that one again.
Are there firms that track labor on lump sum projects which are over budget as indirect labor?
Yes, this goes into my least favorite account. I forgot what it's called. I'll have to come back to that one. I'll answer that. I'll send an answer to everyone for that one. I don't have it right off the tip of my tongue here, so I want to answer it correctly.
Okay, and again, John will be providing you with Kate's contact information for you to follow up with her, and I'll be sure to pass along the question.
Yeah, and Elizabeth, are we not sending a list of questions and answers back to everyone that we don't get to today?
We can.
Okay, all right. That way, make sure that I answer it for everyone, because I'm sure he's not the only person that probably has that question.
Okay, and the next question is from Drew, and Drew would like to know, will the industry data in the presentation be available, or is this something we need to purchase within the reports?
The information that I'm presenting here, so let's go down here a little bit, because I do want to talk about this a little bit. So this data is part of our financial management compensation benchmark survey report. So you'll have the data that's presented here, and this is our most current data, just so you know. So this is the median for other principal. It is the data for the median data for senior project manager. So you have the data here, and that's part of why we want to give you a discount if you decide that you want to buy the report. So some of the data will be presented here. If you participate, I'm trying to think. Management comp and staff comp, we actually give you total direct comp. We give you total compensation back as a thank you for participation. So, unfortunately, yes, if the data isn't here up on the screen, it doesn't fit for you. But hopefully, there's some information here. Then you would have to purchase a report, and so that's why we've tried to make it available at a lesser cost, just so that you can get familiar with it. I will tell you, management comp. It's incredibly useful. We actually always present the base pay, bonus, the total comp. I will tell you part of the data is the billing rates, if there's any perks that they get, where do they spend their time between projects, marketing, overtime. And one thing that we have that nobody else has in that data is if you're doing a compensation study, one of the things that you want to do is you want to compare them to market, but you also want to compare it internally. So we present a piece of data on base pay and on bonus pay that is as a percent of the CEO's salary, as a percentage of the CEO's bonus, so that you have some perspective of how these things kind of work within your firm as well. So yes, unfortunately you'd have to buy the book, but I think that you'll get a lot of good information out of it if you choose to do that.
Great, and Kate, some information on how to participate.
Oh my gosh, we will be, I strongly want to encourage all of you to participate. We will be doing 4 surveys this coming year. The first one will be bonus and benefits, which we mentioned we only do every other year. Then it will be our compensation studies, and the first one is management comp, which is for 18 different positions from chairman of the board down to project manager. So it's really management related. And then about 3 or 4 years ago, I think it's our 4th edition this year, we introduced a staff compensation book. And the intent with that was to say, what are mechanical engineers, electrical, civil, structural, et cetera, what are they being paid, and architects, what are they being paid within our AE industry, just strictly based on their years of experience. So that data is reported by 0 to 1 years, 2 to 5, 6 to 9, et cetera, years of experience. But in each one of those, you get the same output. And then our final one, that's probably one of our most popular ones, is our financial performance survey. And that really basically all you're inputting your income statement data, your balance sheet data. Everything is completely confidential. We'll send you a firm number. So when you send your data in, that's the only time your data is associated with your name. And Other than that, everything that's done in processing-wise, et cetera, is by firm number, so that we maintain your confidentiality. And part of the process, and we'll be hosting some more webinars when it comes time for participation, which is at the first of the year, that we will encourage you to participate, because you also get a free benchmarking tool back, and it's really a tool that lets you look through the different peer groups just with the click of your mouse, and it will show you what the data is and show you how your firm stacks up. If you participate, your data will already be in there. We send it back to a specific individual that you designate in your firm. Your data will already be in there. I'm sure this makes very little sense without it being up here in front of us graphically, but if you have a chance to attend the webinars that we'll be hosting prior to opening participation for each one of those surveys, then we'll cover that in that webinar as well. But I strongly encourage you to participate. If firms had not shared their data, I would not be able to have this data up here on the screen. So hopefully we don't all look to the other guy to participate, and we'll consider participation. And we try to make it as easy as possible. It's an Excel-based questionnaire. The tool that you get back is a thank you, and you get a 40% off of the books, off the reports if you choose to buy them. But the tool that comes back to you is very, very useful and very easy to use, and it's Excel-based as well. Again, we want to thank you, everyone, for making their time to share this data, because it helps us know better how the industry is acting and how it's performing, and we couldn't do it without you. So I strongly encourage all of you to participate, and we actually, unless you're opposed to it, we tend to send out a special email to all of you just saying, hey, you joined us for our budgeting. We'd like to encourage you to participate. But we won't inundate you with emails. We'll just make sure that you get invited. Thanks for
Great.
asking.
Thank you, Kate, for that overview. And again, if anybody has any questions, you can follow up with Kate, anybody here at PSMJ, such as myself. And what is so great about participating in these surveys, especially our financial performance one, is if we do have your permission, we award you, if you make the top 20%, as our Circle of Excellence winners. And we honor them at our annual Thrive Conference, which will be in Nashville this October 13th to 14th. And what we'll do is have a special awards banquet for you, recognize you guys as most successful firms based off this survey, and make sure that you guys get access to the tools that Kate mentioned, and really encourage you guys to participate so you can compare yourself to your colleagues, help you come up with a plan for 2017 moving forward. And we have about a couple minutes here right now, and it looks like we still have some questions left, Kate. So what we can do is go ahead and see how many questions we can get done. And like Kate said, for any questions we don't address, you'll have her contact information, and we'll also send out all the Q&As to everybody to have access to.
So the next, just real quick, Olivia, just so for people have to drop off, just a reminder that we're going to meet again, same time, same place, next Tuesday, September 27th, and we're going to talk about estimating overhead, labor in general. We're going to talk about calculating your break-even direct labor multiplier, and then we're going to put it all together and have a short discussion about allocation of year-end profits. So just in case you have to drop off, hopefully you can join us again next week, and hopefully you've found this information helpful. And Olivia, if you want to ask a few more questions, I'm still here.
Great. So we'll take about 2 more questions. And the first question is, what is the difference between reimbursable expenses and project-related expenses?
Well, hopefully all of your project-related expenses, we're going to go back up to the income statement up here. My hope is that all of your project-related expenses are reimbursable, so that you're not accruing costs like printing costs or anything like that that you're not being reimbursed for, or that are not already included in your lump sum fee. So reimbursable just means it's a pass-through, and that's the difference between gross revenue and net revenue. Gross revenue is, for example, if I'm an architect, I've hired a civil engineer, structural, mechanical, electrical, etc. I'm not going to have all of that money to run my firm, so I need to subtract any reimbursable expenses and any reimbursable subs, or any really pass-throughs is what they're called, in order to get to the net revenue number, which is the funds that I'll actually have to run my firm on. So hopefully you're recovering all of your project costs, including your direct labor. I know that isn't true when you run budgets over on projects, but hopefully you are. That's the goal, the long view goal.
Great. And the last question that we have from today is, instead of EBITDA that you mentioned earlier, what did you say that you measure instead?
Okay, so instead of EBITDA, which when you're looking at public stocks and things like that, you're going to see EBITDA, which is also called EBITDA. We actually prefer to look at EBBT. So E is in Edward, B is in boy, B is in boy, T is in Tom, and that's earnings before bonus and taxes. Because again, every firm has a different bonus strategy and every firm has a different tax strategy. So we will report our profitability numbers based on earnings before bonus and taxes. We'll also go one step further and say we'll report profit or earnings, one and the same. So just for vocabulary, earnings and profit are the same. We will report our earnings based on post-bonus, and then we'll report profit based on post-taxes. So we'll go one step at a time. We start with EBBT, report profit. Then we will subtract out the bonus, give you a new number, which is earnings after bonus but before taxes. And then we'll take out taxes and we'll give you earnings after bonus, after taxes. So when you're looking at our financial benchmarking data, you have all three of those as a percent of net revenue and as a percent of gross revenue.
Great, thank you, Kate. And we are a little bit 1 minute past the ending time for today, but what we're going to do is go ahead and close today's webinar. But before I do, Kate, do you have any closing comments that you'd like to say?
Thanks for joining me today, sincerely, and I really hope that you'll consider participating. Again, the more participants we have, the better the quality of the data. I just want to get to the end here. Make sure you have what you need. The better the quality data that we can report, and the better data that you have available to you to help manage your firm. And I've been working with a lot of firms over the last 10 years, and this data has been invaluable to me. So I hope that you learned a little bit about budgeting. We're going to finish that next time. And I use these same techniques with my clients. So this is something that we use. I have been, again, giving this webinar for about the last 3 years, and I've had people that have used the workbook, and they absolutely love it. I'm sure you expand on it and do all kinds of things to it, but at least you get the fundamental foundation around what budgeting requires. So anyway, thanks again for joining me today, and thanks for the great questions. I think this was a great discussion. So
Great. Well, thank you, Kate, and thank you, everyone, for joining today's webinar. We hope you have a nice day.